Hi, my name is John Perry. Welcome back to the Peak Wealth Podcast. It's been a little while since we've recorded, but I am back and better than ever. With football season almost here, you can see I'm repping my teams. We got the Steelers over here, and of course I am holding out here my Michigan championship belt that I had made, actually. Very excited. So in addition to, approaching the end of the summer investment season, we are heading into what is probably the best time of the year, which is college and NFL season starting and baseball playoffs. So if you can't tell, I'm a huge sports fan. A little bit different attire today. Got the Peak Wealth hat, so I'm sporting the merch today. Anyway, let's talk about some of the things. I'm rolling up the sleeves now because we're going to get down to it. Let's talk a little bit about what's been happening in the markets because it's been a couple of weeks. I've been traveling for business. We had what was a pretty nice speed bump in the markets a couple of weeks ago. The markets had a bit of a precipitous drop over the course of 2 or 3 days. Some of the darlings of the market, including NVIDIA, Apple, Amazon, earnings came out. People were getting nervous about, is there a potential recession looming? A lot of the economic reports that were coming out were giving us kind of like mixed signals. People were getting nervous about what the Fed was going to do with interest rates. And interestingly enough, my comment to my clients was, we just got to stay the course. And, what happens over the course of a couple of days in the market, even a week or so, sometimes it's just an overreaction. And we've had such a good market for the last year and a half, let's call it, 2023 and so far this year, that when you do have pullbacks, you're going to have people that might have hot money in the market, and hot money is money that's recently come in, and the markets don't behave the way they expect, and they end up pulling their money out. And we've also seen, I think this has also contributed to what happened, you've seen the start of a rotation, which is a good thing, from all the tech stocks and specifically the Magnificent Seven, which includes Apple and Google and NVIDIA and Facebook. You've seen a rotation out of those into some of the other areas that potentially might do well now in this next phase of the economic cycle. And financials, healthcare, industrials, even areas like real estate investment trusts, REITs as they're referred to, they have done, even utilities, they have done very, very well over the last month. And in a lot of cases, some of these sectors have outperformed what tech has done. And I think that's healthy. And if you stayed the course, even with those more growth-oriented stocks, a lot of them came back already. You've seen Apple rebound. You've seen NVIDIA rebound. So again, I'm not here pitching any particular company or stock for listeners to buy. I'm simply talking about some of the market behavior that we've had recently and why it's important. I'm speaking for my own profession. I think it's important to work with a financial advisor. I myself have been an advisor for 3 decades. Hopefully I don't look like it, but I have. I've been doing this for 30 years. And I've seen a lot of market cycles. I've seen a lot of market behavior. And when markets move and it's because of an event, because of the change in the dynamic of something going on, whether it's global or domestic, whether it's politics, whether it's a change in policy, those things are understandable if they create a market reaction. But what a lot of people tend to forget is that markets are a behavioral, almost animal-like type of structure. And when that behavior, takes on a viral tendency, you can see these types of things happen where one bad day turns into 2 bad days, turns into a week. But if there is no real catalyst that is going to create a long-term change, then very often, like we just had, it's a temporary situation. When you have a situation like, again, just to give an example, like a stock like NVIDIA splits and goes from $1,200 to $120, that creates almost the psychological impact on investors that it's a cheaper stock, which it really isn't. But I had a number of clients call me up and say, well, can we buy some now? And, for those people that didn't have a position that we did buy, I made it very clear that very often when stocks of that nature, that growth nature, split, it's going to lead to more volatility, which it did. And NVIDIA ran up to 140 very quickly and then dropped into the teens, 115 to 120, ran back up. And then when we had this hiccup in the market recently, it dropped under 100. Interestingly enough, staying the course, if you didn't panic or if you bought more, you benefited when it was down because now it's back up in that 120 plus range. Same thing for Apple. Apple reported earnings. Some people didn't like the results, and the stock dropped from 120 down to about 220, down to about $200, and now it's back up over 220. So this is why I emphasize if you work with somebody that is looking out for you, this is how you can avoid these types of situations where market reactions create investor overreactions. Okay. What does the path forward look like? Again, I don't have a crystal ball. I'm just using my experience over the last 30 years to give my perception of where I think things are going. I think we got a lot of volatility in store. I don't know that there are a lot of catalysts to take us much higher, but obviously one of those is if the Federal Reserve lowers interest rates, which I think there is a good chance they do in September. If that's the case, if we get a larger cut, maybe half a point, I think the market likes that very much. If it's a smaller one, say a quarter point, I don't know that gets a large reaction from the market. I think that would be more dependent on the language the Fed issues after the decision on how much they're going to cut. A lot of the projections that I've read from economists believe that probably the Fed needs to lower rates a total of 1 to 1.5% over the next 4 to 6 months. I think the market would react very well to that. But again, that has to be paired with what's going on in the political arena and whoever is going to win the current upcoming election and what that looks like from a policy standpoint. I think those things obviously play a large role in what happens with the market. But I'm going to tell you one thing that has been proven time and time again. It's not about timing the market. It's about time in the market. And all it takes is missing the 10 best days over the course of 10 years. And it sounds crazy, but it will, if you do that, you're basically going to destroy your returns over the course of 10 years. So that doesn't mean over the course of a year, 2 years, 3 years, you don't make tactical changes, you don't take profits from time to time, but trying to time the markets based on politics or based on events that we don't control, obviously, is a loser's game. And if you look at how markets have performed over the course of the last 20 years, they go up under Democratic administrations, and they go up under Republican administrations. And they also go down under both of those as well. Luckily, for the last 10 plus years, we've had a lot more up than down. So I think, what are the important points to take away from today's episode is that, volatility is not a bad thing in the market. It's normal, okay? It is important to have a plan. It's important to have conviction in whatever type of investment strategy you're using. If you don't have conviction, you shouldn't be in it. Unfortunately, the markets move faster than they ever have. And, after the financial crisis, it took 3 years for the market to break even. When the pandemic hit, starting in March of 2020, over the course of 2 to 3 months, the markets lost about 30%. The markets broke even, came all the way back, and were positive by the fourth quarter of that year. That is an unbelievable move in the markets, okay? And we were all still locked down. So if you stayed the course, you invested in good stocks, good ETFs, companies with strong balance sheets, and you stuck to a plan, and even potentially, like I try to educate my clients to, when the dealer has a weak hand, and the dealer in this case is the market, and something happens where the market pulls back, and it really feels like it's an overreaction, or it's potentially a temporary situation, that's when, again, you own good things, you potentially buy more, okay? Those are the times that you really can create even more significant wealth. So the moral of the story here is to have a plan, to stick to it, and working with somebody like myself who holds your hands during those times, who can explain things when there's some confusion about what's going on in the markets. What are the catalysts? What are the things that I can look forward to, or potentially what's going to happen in the next 6 to 12 months. Advisors obviously can't tell the future, but the reason that we do what we do is to have an opinion and to give people a solid investment plan or strategy that is built to their goals and to their risk profile or their risk tolerance. So I want to stress how important that is to everybody. That's what I would take away from today's episode. Again, my name is John Perry. I am a senior vice president for Steel Peak Wealth Management. I'm based here in Boca Raton. And if you have any questions, if you need my help with anything, you can reach me, like it says on the screen, john.perry@spwm.com. Our episodes are also up on Spotify, YouTube, and Apple Podcasts. So I hope this was helpful to everybody, and we'll catch you again real soon. Go Blue.